Welcome to the Dividend Talk podcast, episode number 22, Investing in Uncertain Times. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to the channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Well, what a crazy week this has been. We've had, I suppose, there's lots of news that we could talk about. There's been elections and vaccines and so much stuff happening. But before we jump into any of that, European DGI, how have you been?
Well, like you said, I was more focused at work, not so much on the stock market, so I was a bit quiet as well. But wow, what a crazy week! I mean, I don't know what your portfolio did, but my portfolio did quite well this week, so I was really happy with that. But other than that as well, the Netherlands had a soccer match against Spain, and honestly, I cannot watch anymore these games with no crowd there. It's so boring. So I started to tune in there, I think 15 minutes late, or 20 minutes late, and I saw it was 1-0 for Spain. I watched 5 minutes. It hurt. It was really painful for my eyes. And then the next day I checked the news, and they still played 1-1. So it's actually quite a good result against Spain. But it's horrible to watch this kind of football on TV now, not specifically when there's no sounds behind it. Yeah.
I mean, I can't sympathize with you because you have a good football team. The Netherlands are a good football team. Have you ever sat down and watched Ireland play for 90 minutes? It is horrible.
Yes, I remember when we lost from Ireland, when it was, I think, qualification for the European Championship. Do you remember that?
I do. We remember all our big ones: the Netherlands, Germany, England. That's all we can cling on to. It's been a tough road for us. Crowds or no crowds, it's really hard to watch. But actually, now that we're on football, it brings me into my news of the week. And I don't know if you knew this, but I didn't. But football clubs actually pay dividends. So the one that I found was on Seeking Alpha, actually, was Manchester United. Now, we all know I'm a Liverpool fan, so I'm not going to invest in Manchester United no matter what. But I just think it's pretty amazing that there's football clubs out there paying dividends. I think Ajax Amsterdam is another one. Maybe these clubs, maybe they're trying to reward their shareholders in other ways because they can't win Champions League or leagues anymore. So I don't know, but it's really interesting, and I might actually have a look around and see what other clubs pay dividends, because I'd love to just invest, or just say I own part of a football club, a really big football club. Just even I know that dividends won't grow, it'll be in my fund portfolio, but just to say, yeah, I own some Ajax or I own some Liverpool, it'd be just
cool.
It'd be awesome.
Well, let me know if there's anyone there, how you say it, that should also join the Noble 30. I'm more than willing to consider it. But yeah, Manchester United paying a dividend, it is a bit awkward, right, in COVID-19. All these clubs are dying because of no commercial income and no crowd, no fans in the stadiums. And then they start to pay a dividend. I mean, if they had one excuse in a year to not pay a dividend, it would have been this year.
I haven't looked into their balance sheet or anything, but I do know United are in massive amount of debt. They have massive amount of debt. So how can they even pay a dividend? Why not pay off this debt? I don't know, but yeah, look, fair play to them. They declared the dividend, and they're going to pay it out I think it's this month or next month.
Well, the question is, will you reinvest it if you would have had the shares?
In Manchester United, no way.
Yeah. Good. Okay. Hey, I also, I said, have some news, and actually, it's the Disney results. I think we both did it right when Disney suspended their dividend. I think that's the right choice of words. Earlier this year, we both said, "Okay, enough." For me, it was like at the time I just lost trust in this new CEO. I mean, he comes in, he straight away suspends the dividend, and I found it felt too early. Yeah. Yes, parks were getting closed, but it's not like the company has a horrible balance sheet or something like that. And I know that they still don't pay the dividend, but they're really being slaughtered when it comes to their parks, right? But then if I saw their subs on Disney Plus, 73 million. It's amazing. So I know that Netflix has around 200 million subscribers now. How many years did it took Netflix, and how many years does it take Disney to get here? And why I find this really interesting is because usually you have this first movers advantage, yeah, like Netflix, and then it's really hard for other companies to compete. And think about the cloud war, where Amazon with AWS, most of the companies kind of failed, not failed from the other company perspective, but to take so much market share like AWS and such growth. Only Microsoft came close by, but IBM, for instance, fails. Yeah. So I find this really impressive with Disney, and it just really shows that content is king, and this brand that they've been building up over 100 years is so strong. And it's also really interesting to see that this is, I think, they wanted to achieve these goals only in 4 years from now, and they are there already. So for me, this is it's not a dividend stock anymore. That's why I don't need it, but it's a growth stock now for me.
Yeah, they have incredible brand power. But I think in this universe that both Disney and Netflix can coexist. I don't think Disney will take over Netflix's audience, for example, because they're two different niches. And I know even for my own family, you'd have Disney Plus for the kids and for the big kids like myself, but we also have Netflix because Netflix has other programs that you want to
Yeah.
watch. So I definitely think they can coexist. But 73 million paid subscribers is incredible for Disney, and it's a true testament to how strong their brand actually is. And their stock price soared even after they suspended their dividend. Their stock price continued to
And
do well.
report the loss. Yeah.
Yeah, yeah.
Yeah.
So I think we both agreed at the time that we still do expect big things from Disney over the next 3 to 5 years, but they're just not a dividend company anymore, and I think that's clear from their new CEO.
Yeah. Yeah, and to this, to your point, right? So we have Spotify, we have Netflix at home. I always my anchor point in my mind is that I paid €50 for internet not that long ago. Yeah, and now internet became a commodity. It's much cheaper. I pay now €20 or something like that for internet and TV and mobile phone subscription. So I've got €30 left, and I'm in Poland. €10 for Netflix, €5 for Spotify. So I still have €15 in my mind. Let's say left for other services. Yeah, and that's how it works. So I think the share of wallet is still there for Disney to exist besides Netflix, and I think there's even an opportunity for a third one, maybe AT&T with HBO. But I think there's still place for a third one, even, I would argue.
Yeah. No, I agree.
Good. So let's go then to the main topic for today. And today it's really interesting topic. So we choose the topic of investing in uncertain times. And when we were talking earlier this week, like because we typically look at what kind of topics we want to do and do a bit of homework, it was really the day that all these value stocks started to pop. Yeah, literally because of the rotation from growth into value due to the Pfizer news and the vaccine. And then it was also a bit then about reflecting on, is this then now showing the confirmation of let's say the kind of value investing approach that we have been taking over the last year? That was this the first evidence that we are getting it right somehow, right? Because that's what, for me, investing in uncertain time means. So I find this a really interesting topic, and I wanted to ask you about when did you really first time experience uncertainty, and what did it mean to you, and what, and specifically also psychology that you had at investing?
Yeah, so as you know, I'm a relatively new investor. I've only been doing this a couple of years, 3 years or so. So I haven't encountered many difficult times. Pre-investing, I did some trading, and I did some sports betting trading and stuff like that. And I tried my hand at FX, and I remember at that time it was right at the financial crash, and I lost a good bit of money doing something like that. But that kind of shaped me and changed my path towards my dividend growth investing journey. But March was the first time that I've really seen a drop in the market, a substantial drop in the market. And I've been ready for it. You've been reading books and you've been reading, and I've always said that if there's a drop in the market, I'm confident in my strategy that I'll just keep adding and keep adding to the pot. And when that drop happened, that's what I sort of did back in March. So if you look at my investments over this year, I think March and April would have been the 2 months where I pumped the most money into the market, just trying to buy stocks that I thought were valued at the time. Like Shell is a prime example, and everyone knows that I bought Shell around this time, and I bought a substantial amount, and they were a beaten down stock, and there was lots and lots of depressive news, I suppose, around Shell, and lots of people saying to me, "Why are you buying Shell? They're cut their dividend and all this carry on." But in my mind, it was the right time to buy them. I could see the upside far outweighed the downside. They already had the downside. And that's how I kind of approached March, looking for stocks that other people are looking, saying, okay, they're done and dusted. I don't think 1 year or 1 quarter makes a bad company. It also doesn't make a good company. But if you believe in the long-term future of a company, and then you see them beaten down, like I put Cisco in that, I put Intel in there, I put Walgreens. I believe in their long-term future. At the moment, there's headwinds. I don't deny that, but I think that is the time you need to buy these companies. It's easy to jump onto companies that are high flying, but the value might already be gone in those companies. So yeah, so that's kind of where my head was in March, trying to identify companies that I thought had value, and then try invest in and ride out and see. Hopefully, then in a couple of years that they'll prove me right.
And then, how do you deal with criticism in that case? I mean, for instance, just a simple question: your family knows that you're investing, right? They probably saw you putting quite some savings in the stock market at that time.
Yeah.
Did that put pressure on you?
No, and to be honest, my wife is the only opinion that really matters to me. If she had a problem with it and had a genuine reason, then I might take a step back, or we discuss it. But anybody else, I mean, I listen to opinions, but ultimately, I'm on my own journey, my own path, and I tend not to listen to anyone else. I'll take advice, and of course, I will, take other people's arguments into consideration. But ultimately, it's my choice. I know what I want from this, and I'm going to get it. So, regardless of if the stock market is up or down, I prefer to buy when the price is low. So if I see a price is low, that's when I want to buy more.
Okay, and then you say there was value, but at the moment in time, how did you deal with the fact, for instance, with the stress in the market and that Shell could drop another 30-40% at that time?
I mean, you're prepared for that. As in, I am a monthly investor, so I don't put 100K into a stock at a particular moment in time. I only have a certain budget that I can put in, and I'm happy to put in. Once I do my research and I have a value price, and I know where I want to buy them. If they drop another 30%, and I'm still confident in my thesis, I mean, if it's only been a month or two, usually not a whole lot has changed in a month or two. I'm still happy to go back in at a lower price. I've done that with both Shell and Walgreens, and I'm starting to see the benefits of that now. Whether I'll see benefits of that in another year or two, I don't know, but currently I'm seeing the benefits of that strategy.
Yeah. Okay. That's really, really interesting. And maybe I can also share a bit of a story. So back in 2008 and 2009, I was already in the workforce, and actually I was investing a little bit. But this was literally like 100 or 200 euros in shares in total. It was really like play money because my colleagues at work were all on the stock market. I didn't have much more savings anyway on a monthly basis, so I played a bit with that. But then I also remember at a certain moment, it was 2009, and in the news it was like, oh, financial crisis, and I remember so vividly that at a certain moment there was a documentary, and they went, I think, and this is good for Daniel from Norway, I think they were in Stavanger in Norway, and they had a documentary there about that the harbor is empty,
Oh,
that there's just no ship coming in, there are no goods being imported, because the whole world economy just grinded to a halt. That was the moment that I bought two stocks. It was my biggest investment ever. I put 600 euro in the stock market, and for me that was literally like I heard a bell like ringing, saying like, guys, the next step here is like riots and everything in the streets, and I cannot imagine this. Yeah. So, and then literally after that, literally a week after that, it started up. So if you would go to the stock chart in 2009 around that documentary, it was the bottom of the market where I bought. And fast forward 2020, in the midst of March, Johnson and Johnson hit $115 or $114. I think it was just one day or 2 days.
hmm.
I had the same reflection on the news. Yeah, I was outside. Literally, I went outside. I saw no cars in the street, almost nobody. I felt afraid to be in the street. It was like a zombie apocalypse. And I thought, like, okay, this must be the bottom. This
Yeah,
must be the bottom. So I went back home. I thought, like, okay, I'm not going to wait any further for Johnson and Johnson to come down. I just buy it. So I bought a little bit more that week. And again, my intuition came there to, this cannot go worse, because what's worst if there are no cars in the street anymore? Nothing. Yeah.
yeah,
Then what can be worse? It means that the whole that then our whole equity is gone, everything is gone. Yeah, because then you get anarchy. And this feeling, I started to recognize that. And I've got a chart in my room here that shows also the Wall Street cheat sheet that shows the analogy of psychology.
yeah,
So I had that feeling again in March. And that was the moment that I felt like, okay, I remembered that from 2009. This is something similar. Yeah. Like everyone's dying from COVID. So it doesn't mean like I buy all at once, but I did really increase my amount of money in those 2-3 weeks that I was buying there. And to your point, these are really uncertain times, because I don't know if I'm right based on my feeling. It's just the second time that I noticed this, and in hindsight, I can say, well, it makes sense. Yeah, because there's nothing worse than an economy that really, really grinded to the halt. If you go outside and you don't see any cars anymore, no planes anymore, means nothing is happening. Yeah, from
yeah,
that point of view.
yeah. It's really hard, isn't it, to not know where the bottom is, but to keep investing. Like I find
Yeah,
that really hard, and we know that from following people on various social media channels. Before COVID happened, there was an array of people promoting buy, 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 and then all of a sudden they were like buy and hold, and then it came to March and April, and the same people were saying sell, sell, sell. Whereas in my mind, it's nearly the opposite. I'd be nearly wanting to sell when it's high, and buy as soon as everybody else is buying it. And for me, I think that came from the losses I had as a trader. I'm doing bunny years here
yeah,
with my hands because I wasn't a trader. But when I tried my hand at that, that kind of shaped me into that. You kind of want to do the opposite of what the general public are doing, really, because people tend to
yeah,
panic, and it's easy to say I will buy when the market's dropping, but when you're looking at your portfolio and you see a huge red figure,
yeah,
you panic, and it's natural. I get the feeling, you
yeah,
probably get the feeling. You do.
yeah. Of
You,
course,
you
of
look at
course.
it. You look at it, and that's one thing I wanted to ask you was, I know you bought Shell, and it went up. But Jim, you had a huge loss on Shell. So I came at
Yeah.
it from a different perspective to you. So
I have 40% loss on
so
Shell.
how do you handle that?
Um, really, really simple. It's a concept of sunk costs. So I learned at a business school. You shouldn't use past investment decisions as input for your decisions going forward. So I have an analytical mind, so I can turn off emotions a little bit there. That always helps. So I know I won't get the money back. So then the question is, do I see better opportunities than Shell to invest in? And probably the answer would even be yes. Yeah, I could have taken the money out of Shell and put it somewhere else in. But from the other side, I still believe in the oil sector. That from where it is now, like again, there's not so much. There are not so many planes in the air, so I believe there's lots of value still to be created. I might not 10 years from now still have Shell, but I find it now a value play actually, and also for the dividends. So yeah, it's just turning my emotions off, EMF, because it makes no sense. It's 40% down, but you need to know my whole portfolio probably from a price appreciation because of the impact of Shell, Chevron, and ExxonMobil and Bayer. Those are four stocks that almost halved in price this year. I think I'm down like a few percent on the whole year. Also, dividend wise, I think I calculated the other day 3% in dividend income because I wanted to check myself, like if I would have been now living off dividends, what would this year have done to me? And I would have lost 3% in income if I wouldn't have invested and reinvested dividends. So yeah, that's really how it is for me. It is, you're right. When you see that going down, you start doubting sometimes. But I can tell you what I did see in March and April, and I'm not going to call them out, but I saw two really big dividend bloggers that are already around there for 5-6 years, and I saw them panic selling parts of their portfolio while I followed them for a long time. And these bloggers were always saying, we are investing for the long term, and our portfolio is designed for weathering a storm. And the first time they see really, really stressed, they started hitting the sell button. And that really, really disappointed me. And I stopped reading their articles now because of that. I can't take it serious anymore. Generally, they have good content. But I've seen this panic and I don't see them reflecting on it at the moment. So if they would now say, hey, sorry, I panicked. But the thing is, and you and I have that as well. Yeah, I don't like it, but people look at what we are doing, and I see that. Yeah, I see that. People, for instance, I was quite talking a lot about Danone, and I know that people are reaching out to me about Danone and this and that, and started investing in Danone because I brought up the stock, and they got inspired by it. Even if I say do your own research, I know that this happens. So as a blogger, you have a responsibility, and for me, it is like you need to write about this. If you do panic selling, you need to write about this later. Why did you do it? Yeah, what did you learn from it? Will you do it again? This is what you own to your public, yeah, to your audience. So these are two really big accounts, and I can't take them serious anymore. I'm sorry for that.
Yeah, but you don't know what risk you're able to handle until you go through times like that. It's so
Yeah.
easy to sit there and say, I could lose X amount. I could lose 40% of my portfolio and I'd be fine.
Yeah.
But it's not until that happens and you're sitting there looking at it, will you really know what risk you can
Yeah.
actually take. But
Yeah.
you're right, you need to own it, and if you panic, you panic. It's human
It's
nature.
fine. Yeah, it's actually
Yeah.
fine. But
It's
be
fine.
honest. Yeah.
Yeah. But if we flip this now, we're talking about uncertain times. We've just had an election. I know we've spoke before, and we said this pandemic, we haven't seen the full effects of what's going to happen to companies and when countries come out of lockdown. And we get news of a vaccine, and now we're soaring to all-time highs. So I'd class this as a little bit of uncertainty in a good way, because
Yeah.
obviously our portfolio is going up. But how do you manage that? How has your investing strategy changed? Not strategy, but will you still invest more, or will you pull back a little bit? Are you waiting for a drop, or do you believe the market will continue to to go?
So, first of all, I don't believe anything in this. I really don't know. I can tell you how I thought when I saw the Pfizer news and I saw the stocks popping up. I thought like this is some really early evidence that value stocks still have how is it are still appreciated. So because my theory is accumulate them more now, use my extra cash to buy more now because I see more value than I saw a year ago. So this I would probably start investing less if it goes up because for me there would be less value around there because I combine dividend investing with value investing. So for instance now for me Johnson is again out of reach. I just give you an example. I picked it up literally 2 weeks ago for $135. Yeah. So many stocks that 2 weeks ago in the sale up to the election, let's say ahead of the election, I felt like a kid in the candy store again. And literally 2 weeks later, not. And the interesting thing is that maybe the stock market is 10% in difference, but those stocks went up by 20%. Yeah, Danone went from 45 to 55 almost. Okay, Bayer, I didn't buy it, but it's a portfolio holding of mine, went from 40 to 48 now. So many value stocks went up 20%. And for me, for most of those value stocks, the value is gone. I think there's still value in Danone as an example, but most of them, they are again in this zone where I feel like this is normal monthly contribution for me. But it's not war chest money for me.
Yeah.
So, and then, for instance, I also spoke about the Trump premium in the past, that is in the market. And I'm a bit confused because with Biden winning, I saw the stock market. So what I was confused about, because I thought like, there goes the Trump premium. It's now I said exploding when the whole stock market went down because it seemed to be an easy victory for Biden. And I think why it didn't happen, why it recovered, is because Biden will be handcuffed probably with the election if the Senate is still, for instance, Republican driven as an example or owned. Then Biden can't do a lot. Yeah. So what it means, like I don't see lots happening with reversal of tax, I say benefits that Trump was implementing and such. So with that having said, I think that's why probably this impact is less. And I do this pop-up that we had, I really contributed to COVID-19, not so much to the election. I think the election kept it rather in balance because they call Trump now a lame duck, but I'm afraid that Biden will be the first 2 years also a lame duck because if the Senate is controlled by Republicans, I don't think they really can drive the agenda. So
I think most of it is driven by COVID, the vaccine.
Yeah,
it's strange for me the timing of the announcement. It was literally the day or the day after Biden was announced as the winner, so the timing was very interesting. But I mean, wow, did the markets react? And I mean, it's nice for me to look at my portfolio, and I'm seeing green figures the whole time. But a part of me is wishing that I capitalized on companies like AbbVie when they dropped to 85 there recently, and now they're up near $100 again. And I know I bought some of them, but you just kind of wish that you dipped in a little bit more when they dropped, because those sort of companies, they should be higher. So they were value plays, and they're slowly losing their value at the moment.
Yeah. And that's maybe really good that you touch upon that, because I noticed one behavior in me. When the market is down, I become greedy. Yeah, but greedy in the sense of, let's say, I remember that when Johnson was at $120, that I put a purchase order on 115. I have an issue with buying at market prices, and I don't know why this stupid behavior comes from. So let's say I have this tendency to see that, for instance, I just an arbitrary example. A stock is, for instance, trading at 3.86% yield. I would probably put the purchase price nice on a rounded number of 4%. And I don't know why I'm doing this, because it makes utterly no sense. And I've often missed out because the stock wouldn't go, let's say, $0.50 lower. And this is such a stupid behavior that I have. And I started to stop doing that a little bit in the last few months, because I noticed that therefore some of the stocks that I wanted to own didn't get triggered, on the purchase order that I had. And I reflected on that. In the grand scheme of things, that is utterly nonsense what I'm doing there. And so I stopped doing that. I do use purchase orders, like, let's say, 10% lower from where it is today, for when something happens and it pulls down, that I automatically catch the dip. But at that time, you have a lot of cash on hand, let's say in March lows, and then you start to become greedy on the $1 or something like that. And I don't know where it comes from. I don't know if other listeners have that as well. This stupid behavior that if I would now be talking about Johnson Johnson at 145, so I would love to own it at 135, then it drops to 135, and I start putting a purchase order at 130. It makes no sense.
As a sports trader, I capitalized on that psychology, because you'd be surprised the amount of people like the round numbers. And like in horse racing or sport or soccer, they have odds of 2 to 1, 3 to 1, and so on. And people would always place their orders at those round numbers.
Mhm.
Whereas if you just went a little bit below and not the round number, if you took 2.95 instead of the 3, you will get hit more often than not. Whereas the guys waiting at the 3 won't get hit. And it's just the psychology. It's just round numbers, and it's just human behavior. We always want more, don't we? We always just want that little bit. So generally, when I'm valuing a company, I will not look at the current price. I will try not to look at the current price, and yield will be the last thing that I look at. For that reason, I don't want to be influenced by that. And if they're undervalued, I will just buy them. And I will still put, like you, purchase orders below, but I will buy them at that price, because I don't want to be influenced by round numbers or
don't get me wrong. I know, for instance, that Danone is, for me, let's say, valued at €65, fair value. But then if it's today at 54.68 or something like that, I would probably put a purchase order for 54.50. And why not just hit the buy button at 68? So I started changing that a few months ago. But I still have this awkward behavior that I recognize themselves. So it's one of the learnings, actually, in uncertain times, that I should not be so stupid. Just not even use limit orders, but just using best order, how you say it, just at the current price, and because it makes no sense. It's penny wise, pound foolish. Yeah. Okay, so I hope this is. We want to speak a bit about this, to share our psychology there. I'm really interested to hear what listeners have to say. Maybe they have any feedback for us. Maybe some more seasoned investors, even, that have, for instance, really got deep experience also in the financial crisis, and really saw the loss of 50-60%, because we haven't seen that in March. I would be really, really open to learn from them. As well, if they have any advice. And hopefully for the more novel investors, I hope this was inspirational for you on how to deal with that. I think both you and I bought really a lot in March and April. So our thesis, hypothesis still need to play out for to a large extent.
Mm-hmm.
So we'll see in a year from now, I guess, if the world comes a bit back to life from COVID-19.
Yeah. Awesome. So we'll move on then to our listener questions. We have a couple of them. And the first one was from Phil, who asked the question, if not covered by the news of the week, Cisco is up 6 or 7%. Did you expect that? Now, we know that I like Cisco as a company, and they are beaten down on price. But honestly, I did not expect this 6 or 7% increase in price. I didn't really have time to look through their earnings. I've had a brief look at some of the slides, and the revenue was down 9%. Earnings was down. I know they beat expectations, but I didn't see anything that gave me a warm, fuzzy feeling inside to say that it should go up 6 or 7%. They kind of gave an indication that they will expect. I think they've had four quarters in a row now where the revenue has been down, but they gave an indication that this slide is over. But I haven't seen that yet. They have plenty of cash on hand, plenty of cash in the bank. But yeah, I was very surprised to see it 6 or 7% up. And actually, Phil had a Twitter poll the day before saying, should he buy the day before or wait till after earnings, thinking that if they had a good earnings, they'll go up. And I posted and told him to wait. I did message him after and said what I actually meant to say was load up on it the day before and sell at a 6 or 7% profit. But no, I didn't expect it. It came totally out of the blue, and I'm going to have a little look around this weekend and see why it's up that much. But certainly from a glance, I don't understand why it's up so much.
Well, I think you're the right person to talk about it. I really have no opinion about Cisco. It's for me still this desktop phone that nobody uses. But we spoke about that before. Okay, so here's also the second question, right? So what are the last goals for your portfolio in 2020?
I mean, my goals are always the same. I just keep adding the same amount every month and increasing my passive income. Well, not passive, but my income from dividends. That's about it, really.
Yeah, it's for me the same. For my portfolio, it's exactly that. I might do some tax harvesting. I don't know what your tax situation is in Ireland, but we have here, for instance, capital gains tax. So I might look back at my portfolio because I, for instance, sold UTX due to the stock split and such. So I made some small I did some small selling, also maybe some options. So I will look a bit through that. And often what I do then in December, around Christmas, when I have time to go to all my statistics, I usually still sell shares to just for my losers that I don't want to have anyway. So I posted today also on Twitter about General Electric. Hey, 50% up. It was of course a bit sarcasm, but I kept it in my portfolio to always as a reminder. But it's also still a great stock for me to use every year for tax harvesting, and that's what I'm doing there as well.
You just reminded me actually that I have to file my taxes. So thanks for that.
I wish you luck still today then.
So we had another question from Dividend Dane, and this would be for you, I'd imagine. So it's about the Noble 30. So he said, with Siemens dividends cut, will they be replaced in the index? And who will replace Sodexo?
Yeah, so it's really simple. The question, yes, it's a dividend cut. I find it really stupid from Siemens to cut it. I think it's a lack of empathy for me. I will have to talk with them. Let's say I will send a message, a complaint to investor relations, because I looked a bit at their figures today and utterly nonsense for them to cut the dividend. It was really not needed. But when I did my back on the napkin analysis, sounds like it was almost the same percentage as their spin-off. So maybe that's why they did it. But to be fair to the Noble 30 rules, they should be out. And then who would be replaced by Sodexo? So I've got a few companies on the list that have been brought to my attention this year. So one is Castellum. I believe that this is how you say it, a real estate company, I think from Sweden, if I have it correct. I know that they have quite some good dividend history. The other one would be Sage Group, SAGE Group. That's also one that I'm considering. And we have Solvay. I don't know if Solvay got into trouble this year. That would be a third company that I have on the list. And a fourth company is Associated British Food that I wanted to look into. It was also recommended by someone. So I have 4 stocks to analyze for 2 replacements. And it should happen somewhere in the upcoming 2 weeks. I don't want to wait too long with it, because I will also update the pie from Trading 12 212 with it.
Sage actually would be an interesting one for me personally, because I use their software, and I'll use their software to help me with my tax returns and stuff. So it'll be interesting to see how they are. And the real estate from Sweden, I'm really interested in REITs in Europe. I don't have any. I don't hold any, but I went searching recently and I didn't find too many that kind of stuck out. So those two are going to pique my interest when you get around to writing about them.
Yeah, so it will be mainly driven by the dividend growth history, not by the fundamentals. So let's see. Got some homework to do, but Dividend Day, don't worry. I'll try to do it really in the upcoming 2-3 weeks. You must know it's really busy at work. If there's anyone that wants to support, for me, it means data scraping through annual reports, collecting all the dividend payments, all the EPS numbers, and the cash flow numbers per share, because then I can build up the database for the Noble 30 there. And also, what I always try to take out of the reports are the pay dates, declaration dates, just in case if I once ever need to do a difference between, for instance, calendar year versus fiscal year or something like that. So feel free to reach out to me if there's anyone that wants to pick up one of those stocks with me and get them data scrape, let's say.
Sweet. And then we have a question from Dividend Wave, and it is about AbbVie. So I think their dividends on the 16th. Will you reinvest at this price or wait for a pullback?
So I've got 100 shares in AbbVie, and that's my max that I want to have because I'm getting the dividend income out of this position. So I'm generally not reinvesting dividends from AbbVie. Anyway, my approach is never to reinvest dividends, only for selected stocks. I'm doing it with Shell because it's at a Dutch broker. It's easy to do. But usually I use the dividends that I'm getting to just increase my buy position for the stock that I want to buy in the given month. So let's say if I would buy stocks every month for €1,000 and I would have €200 in dividends, I would just purchase the stock for €1,200. That's my approach.
Yeah, you know, on the go, they can't reinvest anyway, so I can't do that. But I have an interesting thing going on at the moment where on trading 212 you can. So I have my price set up for my portfolio with auto reinvest on it, and it'll be an interesting experiment to see how that performs over how I perform with my own individual picking stocks when I think they're undervalued and reinvesting dividends in stocks that I choose. So it's going to be a good comparison to have. But in terms of AbbVie, I kind of like them under €100. I have them valued a little bit higher, 120, I believe. So at this price, I'd still be happy to buy. I would just wish they would pull back. When they're around $90, $85, I think that was a great price to buy them at.
So, and the last question is from our friends with the great chart service, IO Charts, and he asks, on the European front, if either one of us ever looked into Rolls-Royce?
No, I haven't. I'd like to buy one, but I haven't looked into them in any depth.
So I looked into them once, and it's a few years ago, so I don't remember all the data. And why I was looking into them, I think I was at the time comparing it with General Electric for their turbines and engines. And the only thing I remember, to be really honest, is like, stay away and never touch this company again. That's just what I remember. So I can't give, IO Charts, I can't give you the details of why, but this is what I remember, and usually I stick to that. I'm like an elephant when it comes to that.
Cool. As always, thanks a million for all the questions, guys. They all really appreciate it, and we love answering them. So thanks very much. Now we'll move on to our favorite part. I get to relax this week. I can just sit back and enjoy this one because European eDGI is going to give us his stock pick for this week.
Yeah, and maybe it's good to mention this, not necessarily stock pick to buy. Well, we changed the section more to inspire people with stocks that we don't maybe often speak about and introduce them and make people a bit aware about it, right? So from that point of view, you had last week, the thing with the awkward name, with the Smurfs, these blue little puppets. So I chose today a grocery store called Ahold Delhaize. It's a company that doesn't exist so long yet in this combination, just 2 or 3 years, because it merged with Delhaize, which is a Belgium grocery store supermarket chain. And what is really interesting is like these are two giants that merged, and effectively Ahold stayed the brand and everything, I would say. And you need to know these are old companies, yeah, both from the 19th century. So I looked it up. Delhaize has been founded in 1867, if I got it correct. I mean, this is, what is it, 150 years ago. Ahold dates back to 1887 when it opened its first shop. So these are companies with a lot of history. Why Ahold, and what do I like about it? First of all, what is pretty unknown is that they have around 60% of sales coming from the US. I mean, it's usually not unknown by the investors, right? But it's pretty unknown by normal citizens, let's say, because they recommend that they recognize the brands from the shopping, from the supermarkets, let's say, in the streets. For me, Ahold went through a really difficult period because some of the former board of directors, I think one or two of them, I have the book here, they even ended up in jail because of fraud. They were simply doing massive fraud. And I put in one of my 5 Bullet Fridays on Halloween, I put a link to an article there. So it's quite infamous, this company, for that period. And I believe it was around just before the financial crisis, I believe. And this book is called Drama Ahold in Dutch, if anyone is ever interested. It reads like a thriller. But after that, actually, it did quite well. It recovered from that. It bought bol.com. It's kind of the Dutch Amazon. And what is really nice to see now also that in the last quarterly earnings reports, their online sales really grew rapidly, also in the United States. And I have a feeling that this is because of such an acquisition like bol.com. I know they keep this company quite independent, but I know how this goes, yeah, in these kinds of companies, because they will see like, okay, people want to order groceries online. Hey, we have a tech stock here. Yeah, so what can we learn from these guys? So I think Ahold has the assets in house really to double down on online sales. I know they're a number one brand in the Netherlands, but also it's a really great company from, I think, a dividend point of view. So because of this fraud and everything, their dividends were cut at the time. It was like literally one big drama. But currently it spots 4%, what is it? 4% 14% yield. What I want to highlight here, please don't be misled by this yield, as this will be your yield going forward, because this company has a policy of, I think, paying out 30 to 40% of their earnings or cash flows in dividends. Their cash flow has been booming this year. So they had a really high growth in their interim dividend this year, based on the early earnings indications. So it might be that the dividend next year or the year after will be lower because of that. That's not an issue for me. I always say I invest in dividend growth. However, I count on this I see this as an outlier this year and maybe next year. I don't see this as normal. So I don't count on these hikes in dividends as something. I don't count myself rich with this. What I see is that the underlying business is steadily growing, and for me, therefore, I want to own this company as a dividend growth company. But I wouldn't be surprised if the year after the dividend will be cut by 10 or 20% because their earnings are lower. So it's for me a mindful choice to take a company that has a policy to paying out a share of earnings. Because I think their business is so stable and so strong that I'm quite confident with their earnings power. It has currently a forward price to earnings of 12. Again, this is in COVID-19 times. We need to remember that many people were using more supermarkets than restaurants. And their payout ratios are also pretty low, and a free cash flow payout ratio at the moment for 30% and EPS 50%. So the share price trades around 23.16, I think, at the moment. For me, this is kind of always attractive within the low 22. Then I would like to buy more from it, but I already own quite a large position in Ahold. So if I buy anything again in low 22, it won't be too much, just a regular monthly trade. So that's all what I can say in a nutshell about Ahold. That has a great grocery store, good online business, strong brands also in America. And I think it has a lot of mojo going for the upcoming years.
Interesting. That's interesting pick from you. I'm a little bit surprised to hear you say, like, as a dividend growth investor, to invest in a company that will pay a percentage, 30% of their free cash flow every year. So your dividends would, it's not necessarily growth, even though it might grow over time. So it's interesting. It's quite common in European companies. I feel I've looked at a couple, and they seem to have this policy of paying out 30% or 40%. I think Smurfit Kappa from last week had the same. Their aim was to pay roughly 30%. So maybe it's more of a European kind of tradition, but no, it's a interesting company, and the history behind it is incredible. 150 years of to be around for 150 years is incredible. So it's no, it's a good company to look at.
Yeah. Thank you then. So I think we came already to the end of the show, and time flies by when you're having fun. I think that's the English saying. I don't know what they say in Ireland, if it's something similar, but it went quick again.
We say something similar, but I can't say it on here.
Okay, guys, we won't hold you up any time longer. I hope you enjoyed your walk, because we know it's quite a popular podcast for when people are on the walk. So if you're listening to us, Wolf, I'm really interested to know where you are now. Make a picture of it, share it with us. I always enjoy that. And yeah, to everyone, see you next week around again, and have a good weekend.
See you all later on.